Welcome to the November 2025 edition of Student of the Market. At THG Retirement Solutions, we try to break down the noise, provide a clear monthly snapshot of the markets so that you can stay informed and focus on what matters most to you. This month, we'll focus on bull market momentum, AI versus tech bubble, Fed policy, and diversification. Stocks enter a historically strong season. U.S. stocks just recorded its best May through October stretch since 1950. You may have heard sell in May and go away. Well, this year, that hasn't worked. Historically, November through April has been the strongest 6-month period for stocks. As you will see on this chart, the market has increased since 1950 on average 3.7% in May to October and 8.7% November through April. US stocks are in a bull market that just turned 3 years old. Bull markets can last a long time. You'll see here the average bull market lasts 74 months. Current bull market has only been going for 37 months, and the returns obviously can be quite high as well. So it seems like we've been in a bull market longer than we have, but we definitely have some room to go versus the average. AI versus the dot-com tech bubble. That's been a huge topic that everyone's talking about. I have even maybe talked to you about it. Comparisons to the tech bubble are common, but earnings growth in particular is really keeping pace with price gains. You'll see on here the earnings growth versus returns of the tech bubble versus the AI today. On a longer term basis, you can see that the earnings growth on that 4-year number between 1996 and 2000, the earnings growth was 79%, where the same time period for today's market is 77%, where the returns were just dramatically higher in the tech bubble. So again, it's not the same thing, but it is something to consider and to look at. Despite the strong performance, in the equity markets, mutual funds and ETFs that are stock equity based have had outflows in 2025. Historically, negative flows have preceded very strong earnings in this category. So really good contrarian signal. Investors who are pessimistic often create opportunity. And so as you'll see here, the flows of stock funds is actually going down quite a bit since March of 2025. We talked about it last month, but a non-recessionary easing cycle has been historically very bullish for equities. And what that basically means is that when we aren't in a recession and the Fed's cutting, stock market returns have looked really good. Tech stocks, growth stocks have really leveraged Fed cuts when no recessions followed historically. Again, you can see on the graph here that when the Fed has cut rates and there's been no recession, what the returns are in yellow. That's where we think we are right now. Bond diversification benefits are returning. You'll see if something's a 1, it is correlating perfectly, ups and downs. And what you'll see here on this bond diversification chart on the right is that the average bond correlation with stocks is 0.19. You'll see in September, we were at 0.55. But in December of 24, we were at 0.73. So they're getting a little less correlated, which is a great diversification method. This year, the S&P has been down 3 months, and 2 of those bonds have been up. So bonds have been a better diversification tool than they have in the past. The bull market looks justified. The Fed is easing without recession, and correlations are normalizing. As we head into 2026, balance is going to be the key. Stay invested, but be selective. Staying diversified and keeping a long-term perspective is how you stay ahead. If you have any questions or want to discuss anything from this presentation, please don't hesitate to reach out to us at THG Retirement Solutions. Thanks again, and we'll talk to you soon.